Good afternoon to everyone joining us today. Welcome to EDC's webcast version of its Spring 2014 Let's Talk Exports Tour. And this is where EDC shares its global export forecast with thousands of Canadian companies, just like yours, in 17 cities across Canada. My name is Phil Taylor, and I'm the spokesperson for EDC, and I will be your moderator for today's webcast. Now, what we'd like to do today is to take you behind the economic curtain, in a manner of speaking, where we can set aside the daily noise of economic news and cut right through to the fundamental core of what is happening today, right now, in the business world. Now, we do this because one of the ways that EDC adds value to our customers, to you, is by sharing our assessment of how global economic trends will impact you. When we do this, we take the combined insight of our entire economics team and make them available to you as a source of information that you can use to help make more informed business decisions. The man that oversees that analysis is Peter Hall. He's our Chief Economist, and he is with us here today. So Peter, welcome. Thanks for being here.
Good to be here.
As I mentioned, Peter has just come back from the Cross-Canada tour, talking with a lot of Canadian companies about where our global economy is heading. Today, we will be meeting with all of you to do the same. So we'd very much like you to think of Peter as your own personal chief economist for the day. He is here to answer your questions, so please do not hesitate to send in topics that are pertinent to your business or issues and challenges that are of interest to you. Use the question button on your screen at any time, and we will answer them in the order in which they are received. So Peter, we want to leave a lot of room for some question time, so let's get right into this. We hear a lot about the new normal. We hear it in news media. We hear it a little bit from our customers as we travel across the country, which basically surmises that slower growth is now structurally embedded for the long haul. Now, you are one of the few voices that are not in that camp, distinctly so, I would even say. So let's start there. Why have you taken new normal to task?
Well, thanks, Phil, and thanks everybody for being with us today. It's great to have you joining us today. You know, as Phil says, it's true. You hear lots about the new normal economy, how it's going to be slower. Just get used to it. Fasten in because it's going to be very competitive out there. It's going to be hard to make a buck. Get used to the slow growth. That's the melee that we're going to have to do business in for quite some time to come. You know, every time somebody like me, some analyst, gets out there and says the phrase, "It's different this time," watch out. That's what new normal is all about. It's somebody coming out there, it's a host of people in this case, going out there and saying, "It's different this time. This is our new paradigm that we have to operate inside of." And we stand back from that and say, is it really? Every time that phrase, "it's different this time," is used out there, it's usually a bellwether of some kind of upheaval that proves itself wrong. And this time around, we are taking that view. Prior to the actual recession happening, in fact, prior to quite a number of years ahead of the end of the last recession, somebody came along and used that phrase. They said, you know, it's different this time. And the effect that it had at that point in time was to get us all to collectively lower our risk threshold out there. We thought, well, if it is really different this time, if growth can go on for far longer than it ever has before, and if we're sort of in this perpetual growth world, why do we have to take as many precautions as we normally would? Well, what this initiated, what that phrase initiated, was a period of excess activity that I don't believe the world has ever seen before. We created a mountain of excesses. A normal growth cycle is 8 years long. We had 5 years of pure excess inside of the world economy. And you know, when the realization hit in that it wasn't really different this time and that we had been imprudent in creating this mountain of excesses, all of a sudden we started to recoil. And that's what initiated the greatest drop in global activity that we have seen since the Great Depression. Well, that looks a whole lot more like a standard business cycle. It's just last time around it was quite exaggerated. So it wasn't different that time, and this time now everybody's out there saying, well, we've got this low growth new normal. I believe that that phrase is being used in exactly the same way as before. everybody's out there saying it's different this time, what we're witnessing out there is that the signals in the economy are lining up and telling us at the moment we're actually on the verge of very strong growth.
Okay, so let's talk about those signals, because I know our audience, okay, well, that makes sense. We're talking about the headline story, but let's break it down piece by piece. So let's start with the headline numbers. Some interesting trends recently and even the past few months. Let's start diving into those. What are you basing your view on?
Well, we've actually got 4 reasons why we believe that the world economy is on the verge of a very spectacular period of growth, a standard growth cycle. Nothing to say, well, this growth phase is different this time. No, it's a growth phase that we're lining up to, and there's standard signals that you can go to inside of the economy that give a cue that this is going on. So reason number 1 that we really believe we're on the verge of that strong growth is take a look at the leading indicators around the world. Now, leading indicators are economic signals that are out there. They're telling us about some aspect of the economy and what it's doing right now. But they're not a signal of something that's already happened. They're not as much a signal of what's going on now, but they point to stuff that is going to happen in the coming 6 months. Those are the ones that really give us a window on the future. They're ones that, when they actually occur, we know that there's other activity that must follow these particular indicators. Well, I could drown you in lots of leading indicators and go over them one by one and show you how it is that they're actually performing. But there's a really neat tool that the OECD has built for 34 countries. It's combined all of their leading indicators and put them into one composite index. And what's great about this indicator is that for 16 of the last 18 months, it has grown. In fact, for 16 consecutive months, it grew. And that has not happened throughout this entire debacle that we have been through. The recession and then the post-stimulus period of time has seen this indicator go up, go down, go sideways. It really has been directionless. Now it's turned a corner. And for those 16 consecutive months, it rose. And I know what you're thinking. You said 16 of 18. What about those other 2? Well, unfortunately, those other 2 were the most recent months that we actually have. So you're probably sitting back and saying, okay, well, that does sound a bit like new normal. You had your 16 months, great, that's fine, but the thing has turned down again. We're back into this seesaw economy where it is directionless and we've got this new normal. I would say caution here, we haven't actually stepped back into that. The reason the last 2 months were soft was North American weather. Now, you're probably thinking, I'm really certifiable now. I've stepped into the realm of weather forecasting. I'm not just an economic forecaster. Well, before you conclude that, I'm actually going to cross-accuse somebody else. It's the Federal Reserve Board that's actually playing the role of weather forecaster, because in their last comprehensive analysis of the entire U.S. economy, in their 7-page executive summary, they mentioned the word weather 25 times. It was in almost every single paragraph of their synopsis of what was going on right across the U.S. economy, regionally, industrially. And so they were the ones that really overemphasized the effect of the weather. Well, it wasn't overemphasis at all. It really was a very unusual period of precipitation and also incredibly low temperatures. And that's had an impact. This arrested activity in North America, but it also had repercussions for the rest of the world. It was enough to actually temporarily halt those leading indicators. Well, the last thing I'll say on this point is, if I'm right, and if the Fed is right, and it really was about weather, then those indicators should be rebounding. Everybody expected them to rebound, but most key indicators now are accompanied by this little 2-word phrase that's very instructive: beating expectations. Everybody expected the rebound to occur, but the rebound is greater than the rebound that everybody was expecting. That's pretty huge. What it's telling us is that the leading indicators are back on track. In fact, they never were off track. This was all reserve demand that weather inhibited, and now we're back to satisfying that demand, and those indicators are bursting up. This is huge for the world economy. So point number 1, the leading indicators are strong, they are growing, and they have rebounded from that temporary weather setback that we had.
Okay, so I'm going to cue you on with something that you just talked about there, which we haven't heard in a long time, which is demand. So we're talking about leading indicators are pointing out. So is this a question then that we have worked off all of those excesses and we've now turned a corner? Or is this more a question of demand is really ramping up and we are seeing structural growth right across the board?
Well, that's a great question. That's the question of the day, really. You cannot have an argument that rests alone on the high-frequency indicators that are coming out, whether they're leading, lagging, or contemporaneous indicators. You can't base a case on that. You have to have some kind of reason for why you see a consecutive increase inside of these indicators, and that reason is fundamental demand. You've hit the nail on the head there, Phil. What we are seeing primarily in the United States economy, but not exclusively, is that pent-up demand is building up in a very big way. What does pent-up demand look like? Well, think back to what I said about how the economic cycle had behaved. We had a period of extraordinarily long growth. We had a 16-year growth cycle, actually. That's very unusual. That's double the normal length of a cycle. On the end of that was this huge buildup of excesses. And by the way, those excesses weren't just North American excesses. They weren't just rich economy excesses. Globalization enabled all of those excesses to be exported everywhere. So consumption excesses in the West became production excesses in emerging markets. It was just everywhere. Everybody participated in this. So it was a massive amount of excess that tipped off this recession. What does a recession do? Well, it takes levels of activity from supranormal levels to subnormal levels. And how long do they stay at subnormal levels? Well, they can stay there just as long as there are excesses to wear off. We had five-year pileup of excesses. It's not out of line for there to be a 5-year period of subnormal activity. That's what we've lived through. And so when you get a long period where things are like that, it's a long period. And people say, well, this has been around for a long time. Maybe this is the new normal. Maybe this is the way that things actually are. You get some people who have joined the labor force over that period of time that don't know anything else. And of course, that's their normal. You tell them that we're on the verge of a period of growth, and they think you're a bit loopy. You know, is it really possible that you could have any kind of recovery? We've never seen that in our careers. And so you rest at those subnormal levels of activity until when? Until you've exhausted the excesses. And what happens at that point? Well, when those excesses are all gone, you've got to struggle just to get back to normal. And that implies very strong growth. Well, what I'm saying is that there is evidence across a number of sectors of the economy and across a number of economies that this is the dynamic that's actually kicking into place. Example, the U.S. housing market. America needs 1.4 million new houses every year. That's what demographic state is, the net new level of household formation. That's how many houses you need. In the excess period of time, they were building 2.2, 2.3, 2.4 million a year for a long period of time. So you had this huge buildup of excess housing in the United States. And that became very obvious in 2006 and then again in 2008 when the big crash happened. Well, building levels didn't just go back to normal. They went way below normal. They went to about 500,000 units, and they stayed there for a number of years. That's how you wear down an excess. But when the excess is worn down and you need 1.4 million new houses every year and you're building at 500,000, that's a lot of growth. You've got to almost triple your level of building in order just to get to normal. Well, there has been substantial growth in that market. 20, 30% a year, and it's only at the million level. It's got to get to 1.4 million. And so there's still 40 to 50% growth inside of a key leading indicator of the #1 economy in the rest of the world. Well, if the housing market leads activity and all the stuff that goes into houses and the rest of consumer spending is in the same kind of deficit, you've got a massive amount of the #1 economy in the world, well over 70% of that economy, that can sustain very large rates of growth for the next couple of years at least. And this is just getting us to normal. So that's amazing pent-up demand. You can see evidence of that in the U.S. auto sector. You can see it in industrial demand right around the world. Investment has been at subnormal levels for well over 5 years now. And what has that enabled business to do? Well, they've used up the spare capacity that opened up in recession. They've been using up that capacity. Now capacity limits are almost where they were when all that frenzy was going on in the economy. With the pace of orders that are coming in at the moment, businesses need to invest, and they need to invest now, and they've got the money to do it. So we're not only seeing consumption, we're not only seeing housing, we're seeing business investment that is on the verge of a wave of activity right across OECD nations here. This is huge. That's what pent-up demand looks like. And that is the kind of thing that you have to add to the leading indicators to say, okay, there's really substance to this, this argument of sustained growth.
Okay, so pent-up demand, clearly, there's a lot there, but we know that companies are not spending. U.S. consumers certainly not spending. They're in saving mode. So what is it that's holding us back exactly?
That's an excellent question. That kind of question could stump you, actually. But,
Did I?
Well, not exactly, because, if pent-up demand means that you have to get out there and consume again, then this third reason means for the first time in a long while, we actually want to get out there and spend. Now, what do I mean by that? Well, back in the 1930s, a preoccupation of the analysts who were saying, look, it looks like we've got a new normal going on here. We're at subnormal levels of activity and the economy is not resetting itself. John Maynard Keynes came along and observed this and said, well, there was plenty of time to actually wear down the excesses of the roaring 20s inside of the economy, and it hasn't happened. Like, there's no reboot that's going on, and that's when deficit financing was actually invented. He said, governments, you got to get out there and boost the economy so people are feeling, okay, well, it's back to normal again, and so we can spend as we normally would. And so that big push was needed. Well, we used all of that capacity up a long time ago. We just didn't have that policy armament there to be able to reboot the economy this time around. So what happened? Well, in the middle of last year, actually pretty close to this time last year, all of a sudden, all on its own, confidence came back. Like, without any need of any kind of announcement or any event happening in the economy, it just came back. And that's saying something. Confidence had been buried for 5.5 years. And Americans, who are the world's optimists, their confidence had been buried for that long. 3 times they tried to get their confidence up out of the recessionary zone, and they failed. And the third time I thought, well, third time unlucky. This just sounds like they're entrenched in a gloomy world. And all on its own, that confidence popped out of that recessionary zone. What was amazing was it didn't just happen in the U.S. At the exact same time, it happened in Western Europe and it happened in Japan. And confidence has really continued on an upswing. It's almost more impressive in Western Europe than it is in the United States at the moment. Put all of that together, and you've got about 48% of world GDP that's actually feeling good about itself. So I think that's one of the most, if not the most monumental achievement, then one of the most monumental achievements of the world economy over the last 12 months. It's just amazing that we are back into our own skin again. And this is a key piece of evidence that we are ready to get back into normal activity again. We've got the attitude, we've got the pent-up demand, the leading indicators are actually helping us out here as well. 3 very good reasons to base a recovery forecast on.
Okay, so some good arguments there to be made, but with all of that confidence and all that pent-up demand, we still have quantitative tightening looming. We know that austerity measures in some parts of the world are still in existence. We know that a number of the fragile Five, they're still getting back on their feet, and it's very, very, very tentative at this point. So how do we make some sense of that, knowing that we're still in a very fragile state? We're feeling better, there's demand there, yes, but how do we deal with this?
Well, it's interesting. We may be in a fragile state, and I wouldn't disagree with that comment. That the legacy of crisis is still with us in financial markets, in fiscal markets. We've got a number of encumbrances that we still need to get over. But the fourth reason that I would give, I only gave 3 out of 4, so I owe you a fourth. The fourth reason that we really believe the world is getting back on its feet again is sort of like icing on the cake. The first 3 are good enough to rest an argument on. This is just a bonus that we get. When we go back to the depths of the crisis, we remember the stories that were coming out of those the Southern European economies that were so stressed out at that time. Greece, in 1 year, incurred a deficit that was worth 20% of its GDP. We used to get really anxious when the accumulated debt over all the years of deficits actually was at 20% of GDP. I guess we've gotten over that a long time ago, but to incur or to add to your debt load by 20% of GDP in 1 year was something that was just thought unthinkable before. You just never go there. They weren't the only ones. At the same time, Spain incurred a deficit in 1 year worth 10% of its GDP. Portugal was doing the same. Ireland was rewriting the book on what was possible fiscally as well. There were lots of economies that were in deep, deep duress at that point in time. The American economy, in 1 year incurred a deficit at 10% of GDP. And there was worry that there was going to be a second year just like it. The number one economy in the world, the most developed economy in the world, incurring a 1 year deficit to the tune of 10% of GDP, these were just things that were beyond description. Nobody knew how to deal with them. And so that was what led to some of the prognostications that, wow, with a problem like this, it is going to be years, it's going to be a decade, it's going to be more than a decade until we get out of this. Well, folks, I'm happy to say we are 5.5 years on in terms of from the onset of crisis. And in one of the last 2 quarters, Greece posted a balanced budget. Spain, in 2 out of the last 4 quarters, posted a balanced budget. These aren't totally structurally balanced budgets at the moment. I want to warn you on that. But getting from where they were to where they are at the moment, talk about monumental achievements, talking about beating expectations. They've done it in half of the time that was given inside of the most conservative estimates of repairing this situation. They're not the only ones. Portugal, Ireland, economies across Western Europe, the United States, all seeing fiscal repair that is much, much quicker than anybody was anticipating. Well, we actually anticipated that this was going to happen. Fiscal forecasting is the forecasting that forecasters do worstest. It's just we consistently get it wrong. Finance departments get it wrong. The Congressional Budget Office gets it wrong, and they're very quickly revising up their forecasts every time they come out with it, because the healing that is happening is much quicker than anybody anticipated it was going to be. It always works out to be this way when you put the right fiscal measures into place. Okay, that's great for them. How does it affect us? Why does this actually contribute to our overall collective well-being, either at the macroeconomic level or even at the regular business level? What's in it for us? Well, when you get to the point where your fiscal situation is getting repaired, like we see at the moment, there's no more need for additional announcements of deep cuts or higher taxes. I mean, that's the bottom line for this situation here. You just don't have to do it again. By the way, have you noticed that in your local newspaper or your TV, radio station or whatever, when the news is on, you're not hearing about the next fiscal cliff? You're not worried about the next big fiscal tripwire that's going to come along? It's just not there. And that's because the repair has made the analysts very red-faced. It hasn't gone away completely. The structural problem is still there. But the need for deeper, ever deeper cuts, taking money off the table, is not there. So what does that mean for us tangibly then as we go into next year? Well, let's think about last year first. In the United States, we calculate that the fiscal situation there took about 2 percentage points away from GDP. Now, they posted growth at the end of the year of 1.9%. So what that means to me is their underlying rate of growth was pretty close to 4%. Okay, so when they stopped taking money off the table, wouldn't you expect that that's the growth rate that you would see? And if it's not just the United States, but it's huge parts of Western Europe, if even Japan is seeing some success in this area, you're talking about a vast portion of global GDP that's really an engine of the global economy getting back on its feet again and saying, you know what, this fiscal situation healing itself is simply giving us a growth bonus. And so we have no problem with a U.S. economy that's actually ticking along at a 4% rate. We don't believe that that's an outsized forecast. It's certainly on the top of the consensus, but we don't believe it's an outsized forecast because there's something that's pretty automatic about that right now. It's already occurring, and government's getting out of the way. And economy after economy is seeing exactly the same thing happen.
Okay, so if we had to close that, you were saying the worst is over.
Yes,
Okay.
absolutely.
So safe to say you're bullish.
Realistically bullish.
Okay.
Yes.
Okay, so let's then go. You've outlined your reason for thinking this way, the four key leading indicators: pent-up demand, return of confidence, and the end of austerity. So makes a lot of sense. What does that mean headline? I mean, when this actually hits the road, what does it really look like in the real world? Are we talking about a big jump? What are your headline numbers, both Canada and let's just say in the world as well?
Sure. Yeah, it always boils down to the numbers. And so very quickly, we're seeing the U.S. economy as the leader of the world economy at the moment. The weather effect is actually suppressing the number that we're going to publish for this year. So 3% growth doesn't look too outlandish, but that rises to just under 4% next year. They're going to be ticking along at a 4% rate from about this point on. So we're very comfortable with what you're actually seeing at a ground level right now. That's the engine economy. Western Europe actually accelerates as a result of all this. Collectively, the industrialized world is actually able, as a result of that, to rise from 2.2% growth this year to 2.8% next year. And for the first time in a long while, the industrialized markets will actually be contributing more GDP to the world economy than the emerging world. However, it doesn't leave the emerging world out. While they may be floundering at the moment, let's not forget, the emerging world is still full of follower economies. These have never been engines in our view. They're just not mature enough to lead the rest of the world. And I believe that the experience they've gone through, particularly in the last 2 years, is evidence of the fact that they're not quite ready to grab the reins of the world economy. They're just not self-sustaining. Per capita incomes aren't high enough. However, they still have very, very active trade functions. And when the industrialized world comes back, well, it's going to pull them along in that slipstream. Emerging market growth collectively is going to rise to 5.5% next year. We see great improvement in India. We see China that's actually going to clock 8% growth next year. Now, we know that puts us on the top of the heap. I believe that we could actually be conservative with respect to that forecast. And there's a whole story to tell there that maybe we would leave for the Q&A. It's too big to tell at this point in time. Put that all together, folks, and it looks like we're going to have a world that is growing at over a 4% clip next year. That's more like old normal than the new normal that we've been conditioned to believe. And my worry inside of this is not that the growth isn't going to occur. My worry is more, are we actually going to be prepared for that as a world economy, as a Canadian economy, as individual industries inside of Canada? Are we really ready to see that kind of growth hit us?
Mm-hmm. And a legitimate question at that. Now I'm just going to take you back a little bit. And we talked about the fragility of the economic situation. That hasn't changed. So you've outlined a lot of the opportunities. What are the risks? What are we looking at?
Sure. The risks are pretty much the same as they have been for a while. A key risk is the fiscal situation. If we have anything that interrupts growth, we are back to thinking about the next fiscal cliff. So we're not far away from that. It's just that growth is a huge healer. And in fact, if that's a message here, growth is actually what has enabled us to say the risks that we had on the risk table, for our last number of forecasts are just not as great as they were. The probability that they will actually wreck growth has diminished. So the fiscal situation is one. A second risk is the global financial situation. Let's face it, big banks are still failing stress tests out there. There is still a lot of repair that needs to happen. Banks are still trying to achieve Basel III targets. There's still a regulatory process out there that is actually limiting their activity. So, that's a constraint on the world economy, and there still is structural weakness there. Growth will help that as well. But, that is also a situation we're keeping our eyes on very carefully. Confidence has not recovered for long enough that we're out of the woods. So anything that comes along could interrupt our confidence situation. But I would say those are risks that are on the table. Risk number one I haven't talked about yet. And risk number one is really, we have had extraordinary policy measures that have really been a tide through this very difficult period that we've walked through economically over the last while. And one of those is something we've never seen before. Out of the Great Depression came thinking on what was done wrong at the time. And one of the things that was done wrong was they didn't provide liquidity when banks were failing or when there was risk of them failing. And that actually caused a bad situation to get much, much worse. And so people were lining up around banks trying to get their money out because there wasn't enough liquidity in the system. This time around, we were wise to that. And that's why we had quantitative easing. Never before done. Nobody has really known what the implications or the impacts would be of quantitative easing, and we're still writing the book on what we think those are. It was a very successful program because it kept the global financial system from melting down. However, there were unintended consequences. Essentially what quantitative easing did, as far as we can see, was to flood the world with liquidity at a time when nobody really needed it. People weren't borrowing. You know, they were definitely not in the housing market. They were trying to deleverage. So consumers around the world were really in this deleveraging mode. And businesses, they had all kinds of spare capacity, so they didn't need to invest. So where was all this liquidity to go? Well, we believe that it found its way to the end of the market in a search for yield. It really went into much riskier instruments than we would normally put that money into. And what it did was it elevated stock markets, particularly emerging market stock markets. Emerging market currencies went on a wild ride as a result of this as well. They were really boosted through carry trade activity. Thirdly, it went into emerging market bonds, very risky ones actually, that had very high coupon rates on them. And we couldn't believe actually the amount of spread compression that was happening in very, very risky markets. So a lot of liquidity made its way to emerging markets. There was a lot of really easy borrowing that was happening at that time. And finally, it propped up commodity prices. You know, we had a weak world. Inventories of commodities were high, but at the same time, prices were high. That never happens. So there had to be something in there that was actually boosting those prices up, and we believe that it was the liquidity. Well, what happens then when you start turning the tap off? Well, we haven't turned the tap off yet. We're dialing it down gradually through this process of tapering at the moment, and even then it's having huge effects on all four of these categories. That's the proof to us that our reasoning on these four areas really held water. Emerging market stock markets went into a tailspin after last May 22nd, Ben Bernanke announced tapering. Their currencies went into free fall for a while. Thirdly, their bond spreads started to widen out again as people were bailing out of emerging markets. And at the same time, what did we see? Well, growth was occurring and commodity prices were coming down. That doesn't usually occur. So here we are, we're midway through the process of tapering. Nobody's even begun to talk about what happens when you actually start to net reduce the amount of liquidity that's on the table. So we have this crazy conundrum here where growth is actually taking off, and atypically, financing, particularly in emerging markets, is becoming thinner. And atypically, commodity prices are going down. Well, we believe that's what we have to get used to, and that's what we have to prepare ourselves for. Now, I'm going to ask my own question here at this point in time. Does that mean that this process of diversification that we've undergone inside of Canada is over? Should we retreat from emerging markets because there's all kinds of new financial risk there, and should we just go with the safe markets? And I would say absolutely not. I mean, unequivocally not. What this capital vacuum inside of emerging markets is creating for us, cash-rich Canadians with well-organized banks, is an opportunity to put financial facilitation into the package of goods and services that we are offering to emerging markets, and putting together a solution that says, hey, if Canada ever had a moment where we could get into these emerging markets, now would be that time, because we have a fulsome solution that enables us to write down more business than we would otherwise be able to do. So thanks for asking that question.
It's my job here. You're honing on it. It's interesting because we were just doing some work with our CEO, Benoit Degnaud, our new CEO. He said the exact same thing, which is if you approach emerging markets as you would the stock market, well, you buy low and you sell high. Well, they're low. Now is the time to go. So we certainly hear that. Certainly heard that as we were moving across the country. Definitely, there are opportunities. And when we think of the Canadian dollar being weaker against the U.S., well, it's a prime time to take that Canadian dollar into other markets where you have a benefit of strength as opposed to a benefit of weakness.
Absolutely.
So Peter, I see we have about 6 minutes before I'd like to open up the question and answer period. Let's talk about Canada. Let's talk about the total benefit for Canada. Where does this leave us? Where are opportunities? We won't get into the sectors. I think we'll leave that to the Q&A, but let's look at headline. What does this mean for us at home, and how should we approach it?
Well, that's the point of all of this. Let's bring it home. Let's say, what does all this mean to us? Well, this kind of revival in global demand is very good for us, and it's very timely because Canada has been very atypical through this crisis period of time. And now we don't really have much more bandwidth on our domestic economy. What do I mean by that? Well, we have very indebted consumers at the moment. We have an overbuilt housing market. We have provincial governments that are still sort of in austerity mode. They're taking money off the table. That's a huge part of our economy right there that really doesn't have a whole lot of growth prospects. So you might say, okay, well, are you predicting crisis for Canada at the same time as growth is reviving elsewhere? No, because at the same time as the domestic economy is softening, the trade side is ready to bail it out. Trade and trade-related business investment. Those two things together are Canada's ticket to higher growth as we go forward. So what do we have here? Well, we have global demand that has risen to the point where, you know, there really is demand for Canadian goods and services out there like there hasn't been for a number of years. Second of all, we've got a weaker currency. Now that makes perfect sense. If we are actually going to see growth take off and commodity prices come down, well, we're a commodity currency. That might not be the greatest news for those who are in the commodities business, although we still believe they will do a roaring business over the next while. Volumes will be good even though prices are low. But what that does is that means that the weakening that we have actually seen in our Canadian dollar over the last half year or so is something that makes sense. We believe it's going to be around. Our forecast for the Canadian dollar for this year is 93 cents next year, with risk almost squarely on the downside. You know, if anything, we're likely to see a weaker Canadian dollar. Put those two things together, that's why we have confidence that although our GDP forecast for Canada is 2.2% this year, 2.8% next, we're going to have two back-to-back years of 6% export growth in Canada. That's a huge dynamo. That's bringing a lot of investment in. I could talk a long time about the number of investment projects that we have going on here in Canada. I think I do need to say just a couple of things about what industries are going to be doing over this time. The forestry industry is out front in this, double-digit growth this year and next as a result of what's going on in the U.S. housing market. The agri-food industry is doing well thanks to a bumper crop, thanks to high prices at the same time. That's one that actually has a lot of long-term potential growth because of the rise of the emerging market middle class. There's a whole essay that I could give on that, but that's a very, very good sector to be in at the moment. Our metal sector is going to do very well. We've had a lot of projects that have come into play, so prices may not be good, but the throughput is going to be very strong. Here's one to watch. If you're in the machinery and equipment industry, this wave of global investment that we expect to see rolling into 2015, but starting right now, is going to kick growth up from about 7% this year to 13% next year. This is the first time in a long while that this industry has actually seen growth along these lines. There's lots that's in there. There's industrial machinery, there's specialized equipment, there's agricultural equipment, there's mining equipment. We believe it's all going to roll together, and these times are going to be very good for this particular industry subsector. There's a whole lot more that I could say, but it just looks to us here like what we are seeing inside of the analytics, what we are hearing from people as I've gone right across the country is this is already in train. This is happening now, and our counsel to everybody is, look, buckle up. These times are good. They are getting towards what we used to call old normal, you know, where growth can actually kick up in a big way. And if there's anything that we would want to encourage, it's like, let's not miss out on this. And, you know, if you happen to need EDC or not for this, we are here to help facilitate this activity. But we firmly believe that now is our time, now is Canada's time in a very big way.
Well, thank you, Peter. I think we're going to go straight to questions. But before we do, any very quickly 30-second last thought that you'd like to share? If there's one thing you'd like to leave with our audience, what would that be?
Well, you know, at the risk of sounding too cute, I'd just like to wrap it up this way. It is different this time, but it always is. You know, economies grow, there's a dynamism there, there are new things that happen all the time. And so, yes, there are aspects that are different out there. There are lists that people can give you that seem to substantiate that it is different this time. But you know, every time that phrase is used, whether it's new normal or it's different this time, it usually causes upheaval. And I think this time, even if it is going to cause upheaval, at least this time it's upheaval.
Oh, Peter. Okay, let's go straight to questions. Okay, looking at this, I think what we want to look at, let's unpack the Canadian dollar. You touched on it very briefly as we were going through, but someone is asking, and quite rightly so. Okay, so we know where we are right now, but where are we going for the next year and maybe a little further out, 2 to 3 years? Is there a long-term trend that we can track?
You know, this is a question that I received quite a few times when I was out on the road. You know, if we're really launching into the next growth cycle, how long can we expect that cycle to be? You know, is this just a 1 or 2 year thing, and then we're sort of back into a period of stagnation or what have you? We've been so conditioned to think this way. That's a fair question. Well, we believe launching us out into this cycle is only the beginning because, frankly, we still have very high unemployment rates. We haven't got job markets that have really recovered in any way. So when we get the initial kick of growth for the 4 reasons that I've given, what that trips off is, well, we start soaking up some of this surplus labor that's been sitting around for a while. And when all those folks start getting jobs and start getting incomes, it just adds to the juggernaut of activity. And I believe we've got enough capacity inside of our economy at the moment that even with higher interest rates, you know, we're looking at a growth cycle that could be close to a standard length. In fact, when you overlay on that the fact that there are going to be new emerging markets that are coming in to play over this growth cycle with all kinds of fantastic growth potential and the possibility that India actually kicks up into a higher gear, we could be looking at cycles that are permanently longer than they would otherwise be. I have no trouble thinking that we could be getting launched here into an 8 to 10, perhaps even to a 12-year growth cycle, and to see that occurring for quite some time to come. So that's where we are. If you thought we were optimistic, you know, there's a little bit more to go on there. We certainly believe that there is a sustainable story here for the world economy that could take us quite a few years out.
Okay, and the impact on the dollar?
The impact of that on the dollar is initially, as this quantitative tightening process occurs, well, we will see commodity prices continue to come down. And because of the 2-speed Canadian economy, we don't believe that we're actually going to need to increase our interest rates as quickly as the Federal Reserve Board and other central banks might need to. And so those are things that would actually weaken our currency. And if anything, you know, our low 90s currency could turn into a high 80-cent currency over that period of time. We see,
so what period of time?
We see somewhere around 2016, 2017 is the point where that would actually turn around, where the process of quantitative tightening is more or less complete. And then we see a return, a rebound of commodity prices, although just modestly. We're not looking at any big spikes here.
Okay, great. Thank you, Peter. The next question, I have a number of questions on this actually, which is, should the USA remain the first choice of a new exporter, particularly in the services industry? It's an interesting question, one that we do get a lot. Is that the first step that you should make? I think every value proposition for a market is different. Having said that, if it is your first step out, the U.S. certainly offers economies of scale. It's less expensive to travel there to build business relationships. The laws are certainly much more aligned with ours in terms of business law. But Peter, what would you think on this from an economist's point of view?
No, it's a good question. It's a fear, actually, that many have out there. Are we just going to all default back to that easiest market in the world to deal with and you know, forget about the enormous, the very dramatic diversification that's happened over the last little while? Well, clearly, if it's the first place that one is going to, it is a pretty homogeneous market, you know, language-wise, legal-wise, product demand-wise, and so forth. Yes, but it's not a trouble-free market to deal with like it used to be. You know, we just don't have the same sort of paradigm. We've had a thickening of the border that has occurred. There's the Buy American policy that companies anecdotally are saying is bringing non-tariff barriers to bear on their international trade activity. Look, America is always going to be our best friend out there. There's no question about the freeness of most of the trade that goes across our borders. And certainly if one is inclined to be risk averse, it is probably our best bet. However, we are seeing a lot of startup companies that are saying, look, the world is my stage. I'm selling things through my web portal. And so I set myself up on there. Am I going to turn away somebody from Sri Lanka from buying something from me over the web through a PayPal account, you know, just because they're from Sri Lanka or any other part of the world that I'm less familiar with? Well, absolutely not. So many new businesses doing business the way they are doing it by e-commerce, whether they're selling goods or whether they're selling services. It's a whole lot easier to sell services over the web at this point in time, and certainly into the future. Why stop at the United States? Why not sell to the rest of the world? It's becoming far easier to deal with as much as halfway around the world in real time with product specifications, photos to accompany things. The risk mitigation, just in terms of the uncertainty of doing transactions, has never been lower. Sure, there are still risks out there, but the ability of somebody running a business out of their own living room to deal with halfway around the world has never been easier. So I would say, don't stop at looking at the United States. Yes, it is the biggest market in the rest of the world, but sometimes you might find it actually less difficult to deal with a market that is really trying to grow quickly and trying to get encumbrances out of the way. And let's face it, over the long term, our traditional market space is not going to be the fast-growing part of the rest of the world. We're going to get to a point where, you know, some of them are growing 1.2, 1.3, 1.4% a year. The United States, maybe around 3% a year, when the average for emerging markets is 5.5%, 6% a year. You know, do the math. It's a great opportunity to deal with those fast-growing markets.
Well, talking about fast-growing markets, we have a question about Middle Eastern countries. One, what do they contribute to global economy, let's just say the next 5 years or so? And should industries be focusing on that area in the world? Well, obviously, very sector-specific, but let's take it generally. Let's kind of unpack the Middle East, look at them maybe piecemeal, and what they can do over the next 5 years.
Sure. Well, the Middle East, as we all know, is a very wealthy part of the world, and it's a very cash-rich part of the world. So in addition to the standard strengths of the Mideast market, let's face it, they're awash in oil, they're awash in the world's cheapest sources of oil. That's not going to go away, and the cash flows are not going to stop. These are economies as well that are using that cash to do very significant internal development of their economies, building infrastructure, building cities from nothing. These are mega projects that redefine the word mega. And so there's a lot of internal activity that's going to be happening. There's also a lot of cash. And remember, I said this is going to be a growth period of time where there's actually going to be a cash vacuum out there, particularly with some markets. Well, the sovereign wealth funds of the Middle East market are actually a real opportunity as well. They will be able to continue underwriting the business that goes on in their zone. So that's a great source of export growth. But don't forget that they would be deploying this cash into some of these fast-growing emerging markets as well. So walking in with them as a partner to particular deals opens you up to more liquidity that enables business in third markets, let's say, markets other than just simply between Canada and the Middle East markets themselves. So for a number of reasons, they represent a very strategic place to be doing business. And of course, that's one of many reasons, or a couple of many reasons, that EDC has an office in the Middle East zone at the moment.
That's right. Okay, Peter, so we're running a little bit out of time here, so we're going to have to move through because they are coming in quickly here. So let's move on. Can you comment very quickly on the situation in Russia/Ukraine as it relates to opportunity or investment for in emerging economies? Clearly, I mean, it will hamper trade in the short term, but what are your long-term views?
Sure. The Russian economy is one where we've seen a number of great opportunities over the last while. Clearly, you know, they've got a very substantial oil and gas sector, and the opportunities there are huge. But we've actually seen a lot of opportunity in other segments of the market as well. Russia is a breadbasket nation of the rest of the world, and so our agri-food sectors have been able to talk to each other and do a lot of business there. Agricultural equipment has been a big one as well. So there is quite a substantial Canadian pipeline of business in Russia at the moment, and a lot of potential for remarkable growth. So the events that have happened there over the last little while have really thrown a wrench into the works for many Canadian businesses, and we sympathize. We've paid very close attention to this and have engaged in at least weekly briefings. At the height of the crisis, we were actually doing daily briefings to our senior executives about the situation there. May 25th was a pivotal moment in that whole theater. That was the Ukrainian election. And we are far from out of the woods here, but the successful resolution of the election, the first round choosing of a new president, has it was a remarkable achievement. It's enabled Russia to actually back off since that point in time. The West is still keeping up its pressure on Russia at the moment, but there have been significant movements away militarily that have happened, and even in terms of the rhetoric against Ukraine, that has softened as well. And Ukraine has been left to manage some of its more thorny affairs all on its own over in the days since the resolution of the election situation. Look, we're still keeping a very close eye on how things are unfolding there, but we don't at this moment see sanctions that are going beyond the symbolic sanctions that were actually made and leveled at Russia. The meetings that are going on at the moment in Poland are going to be critical. At this point in time, the United States, Canada, other Western nations are talking about this situation in real time at the moment. We're paying very close attention to that, but it looks like we are through the worst of the political situation at the moment, and it's back to dealing with the economics of the situation, the severe economic duress that Ukraine is facing at the moment, trying to resolve that and getting that section of the world back as much as possible toward normalcy. So we're watching the situation very carefully, but the most recent developments have been very positive.
Thanks, Peter. Let's get into inflation. Starting to see that starting to creep up, and then back up and creep up and then back off. Seems to be that up and down that we've seen. Let's talk a little bit about what would be the impact of the inflation as you see it in your forecast moving forward in the next year or two.
Well, very, very simply put, the impact of inflation would be a significant tightening of monetary policy. Now, don't think of it as monetary authorities putting their foot on the brake and slamming the brake on the world economy. That's not what they want to do. They're actually taking their foot off the gas pedal here. The pedal is to the metal at the moment. We never get more stimulative on a monetary sense than we are at the moment. This is rewriting history essentially at the moment. And the European Central Bank is actually still looking at additional stimulus as we speak. I believe that the circumstances that we're in at the moment, if we're right and growth is ramping up, it is still catching us unawares. It's going to happen really quickly. And I think that the difference, the distance between the disinflationary talk that we see at the moment and above target talk has really become a whole lot more narrow. And so we could see an uptick in inflation that happens reasonably rapidly. And if anything, I would say that monetary authorities may have to increase interest rates more quickly than has been anticipated. Again, this does not hamstring the world economy because the point of this is actually to sustain growth. And let's face it, we've gone through many upticks in the cycle where growth is really ramping up quickly and interest rates rise, and it's actually very sympathetic to the rate of growth inside of the economy. So don't think of this as being something that is going to kill the economy. If it kills the economy, it's actually failed, and we go back into deflation or disinflation. So it's a matter of fine-tuning so that growth is maintained and that inflation doesn't get out of hand. And I believe that if there's anything that central banks have learned over the last 20 to 30 years, it's how to do that. What they don't know really how to manage, there's no playbook really on disinflation or deflation, getting through that.
Well, we don't want to go there.
Yeah, well, what I would say, is a little inflation in the current context is not a bad thing.
It's a very good thing, absolutely. So we've got a question which is in French, just for our audience, given simultaneous translation. If we were to read this and answer it in French, unfortunately we don't have the English version of it, so we're actually going to do this in English. Normally we would answer that directement en français pour vous, sauf avec notre traduction simultanée, nous n'avons aucune chance de le faire traduire en anglais. So I'm going to read this in English for you, Peter. We are a company that specializes in the distribution of food products in Europe, principally in France. With the current changes in politics and economics over the past few months, I'd like to know what the trends are that you can expect on the European side in the coming year or two.
Well, it's interesting. Very, very well put question. Merci pour votre question. We are sort of at a crossroads at the moment. It's amazing to me that Europe has gotten through one of the greatest possible test that you can imagine of European integration, and they can see themselves coming out the other end of that, and all of a sudden the European Parliament is getting filled up with detractors, those who are not in favor of regional integration. And I got to stand back from that and say, I don't fully understand that. In terms of a lag structure of political reaction, boy, this is a pretty long one. And so I'm puzzled by that development at the moment, because this should be a time, as confidence is recovering, that people are saying, well, maybe those who predicted that the first recession was going to finish this integration were completely wrong. And we should actually be much more upbeat about prospects for regional integration. Well, I'm heartened by the fact that the majority of parties in the European Parliament are still pro-European integration, and I believe that that's going to carry us through this difficult period of time. So I'm not getting overly worried about fragmentation of the Union. I believe it's going to intensify the amount of debate over the next little while, but I don't believe it's going to bring it crashing down. So what is the real story then for the agri-food sector? Well, I believe that the CETA agreement, the free trade agreement between Canada and Western Europe, is still well in train. There's nothing that's happened politically there that's going to get in the way of progressing on this free trade deal. If that's the case, the agri-food sector is by far and away the #1 beneficiary from this free trade agreement, identified by the study that was commissioned and executed in 2007, and it was published in 2008. If you need the results of that study, I would be more than happy to share those with you. But there's a key metric in there, and the agri-food sector is the one that, bar none, is the greatest beneficiary of the signing of that deal.
Thanks, Peter. We're going to have to wrap up. We're getting pretty quick, but there's two last questions that we'd like to get to. One, which is actually, I think I can handle this one, but I'll let you jump in. What is the average of expected export value for an average acceptable export in your categories to be considered an occasional customer? Well, let me be perfectly clear on this regard. It doesn't matter if you have not exported for 5, 10, 15 years. If you have a transaction where you are selling outside of Canada, we can and will and would like to help you with that transaction. So there is no criteria for how often you export, except for some very rare circumstances that are applied to direct financing for your company. However, on a transaction basis, if you have a transaction and you have not exported a number of years, that is not an issue. We can help you manage those risks. We can help you ramp up your financing to service that contract. Definitely here to help in that regard. So please, the restrictions are not necessarily related to how often you export. It is really related to the fact that you are exporting at this time. Anything to add on that, Peter? Or
no, not really.
Okay.
I think you've dealt with that question. The only thing that I could add is, regardless of the risk, at least ask us.
Yeah, exactly.
Just talk to us, whatever that happens to be. Don't shut anything down before you actually pick up the phone or send us an email or what have you. We'd love to talk with you about whatever the prospect is.
Okay, Peter, 2 minutes. We have to do this very quickly.
Yep.
Brazil. Can you comment on opportunities in Brazil? Which industry segments do you see as good segments to start an exporting business to that country? I do want to answer you actually directly on that. On June 12th, we will have a seminar on how to grow your sales in South America. A great opportunity if you're interested in Brazil. We'll have experts specifically related to that. But Peter, very quickly, some top line.
Right. Brazil has become a more risky place to deal with over the last 12 to 18 months because it's dealing with something that many emerging markets have to go through, and that is the realization that they can't do it all on their own. They want to be able to do it on their own, but they just don't have the superstructure to be able to create the infrastructure capacity to facilitate the kind of growth that the economy could realize. And so, unfortunately, what we are seeing at the moment is FIFA is a reality, and people are fire sailing their FIFA tickets because venues are not complete. They're not sure if they're going to actually be able to get to their venues. The publicity around this is really awful, and it's really a shame that this is the case. It's a huge world event. It's an ability for Brazil to showcase what it really can do for the rest of the world, and it's not looking good at this point in time. I believe they'll pull it off, but it's just not the greatest showcase. They've got the Olympics coming up. The IOC is very worried about whether they're going to be prepared for that. This cuts right to some key difficulties of dealing with the Brazilian economy. And we haven't by any means given up on the Brazilian economy, but until the economy realizes what it needs in terms of deregulation, opening itself up, facilitating that international trade that enables them to create what it is that they need to facilitate their own growth, the economy is going to be held back. So we're not bullish on their near-term prospects. Their long-term prospects, completely different story.
Definitely an infrastructure play.
Absolutely.
Absolutely.
Yeah.
Okay, well, unfortunately, that is our time, and we won't be able to get into to further questions. So I have to say thank you to you, our audience, for some really good questions. And of course, Peter, thank you. Really thoughtful and engaging discussion. That was a lot of fun.
Pleasure.
I really enjoyed that. We hope you enjoyed it as well. And through that, we do hope that we have given you a better understanding of the global trade environment and have helped you in your planning process. If we've done that, we've done our job today. Now, for those of you who may want to revisit a few things that Peter has said, went by too quickly and you didn't quite catch it, we will be sending you an email with a link to this discussion when it is posted. And that means that the webcast will be archived so that you can refer to it at any time when it's convenient for you. Well, thank you again for joining us today. Thank you for the privilege of your business. We are very grateful that you chose EDC today and hope that you will do so again tomorrow. And until then, have a great day in trade.